Every year, thousands of American buyers walk away from thousands of dollars in government home buying assistance simply because they misunderstood one word in the fine print: forgivable. Many assume these programs hand out free cash with no strings attached. That single assumption has cost families their down payment grant, their closing cost credit, and in some cases, their entire purchase. Government assistance is not one program. It is a patchwork of federal, state, and local initiatives, each with its own occupancy rules, income caps, and repayment triggers. Buyers who treat them as interchangeable often disqualify themselves before closing day even arrives. Today, we break down exactly how this assistance really works, the legal mechanics behind it, a real-world scenario showing what happens when it goes wrong, and a verification checklist you can use before you ever sign an offer. If you're serious about navigating American property purchases the right way, hit subscribe to Land Guide USA. We publish detailed, state-specific breakdowns of land and home buying rules every single week. At the federal level, 3 agencies anchor most assistance: the Federal Housing Administration, the Department of Veterans Affairs, and the U.S. Department of Agriculture Rural Development Program. Each ensures loans rather than issuing free money, lowering risk for lenders so they extend credit to buyers with smaller down payments. FHA-backed loans allow down payments as low as 3.5%, but they require mortgage insurance premiums for the life of the loan in most cases. That premium is a genuine cost, not a hidden trap, and buyers should calculate it into their long-term budget. VA loans, reserved for eligible veterans and service members, can require 0 down payment and no ongoing mortgage insurance. Eligibility hinges on a certificate of eligibility issued through service records, not on income alone. USDA rural development loans target designated rural and suburban zones, verified through an address eligibility map. Income limits are strict, typically capped relative to the area's median income. Beyond federal programs, every state operates a housing finance agency offering down payment assistance, often structured as a second, silent mortgage. These funds frequently carry a deferred repayment clause tied to selling or refinancing the home. One overlooked legal mechanism is the federal recapture tax, which can apply when a buyer sells a home financed with certain bond-funded assistance within 9 years, and their income has risen substantially. This is precisely the fine print surprise from our opening story. Mortgage credit certificates let qualifying buyers convert a portion of annual mortgage interest into a direct federal tax credit. This is not a discount at closing. It is realized when filing yearly taxes, a distinction many buyers misunderstand. Nearly every down payment assistance program requires owner-occupancy for a minimum period, often 5 years. Renting the property out early can trigger full repayment of the assistance received. Programs commonly set both household income ceilings and maximum purchase price limits, adjusted annually by county. Exceeding either, even slightly, can disqualify an otherwise approved buyer mid-transaction. As always, this video is educational content, not personalized financial or legal advice. Program terms change frequently and vary by state, so confirm current details directly with your state housing, finance agency, or a licensed loan officer. Consider a hypothetical buyer, Maria, purchasing her first home in a mid-sized suburb using a state down payment assistance grant structured as a forgivable second loan. Maria assumed the assistance was a true gift, since her loan officer described it as forgivable. She signed the closing documents without reading the full repayment schedule attached to the second mortgage. 2 years later, a job opportunity required Maria to relocate. She sold the home, unaware that the forgivable loan only fully forgave after 5 years of continued occupancy. At closing on the sale, the title company withheld the remaining unforgiven balance of the assistance, reducing Maria's net proceeds by several $1,000s she had not budgeted for. Maria's outcome was entirely legal and disclosed, but she never verified the schedule herself. A 10-minute review of her loan documents would have prevented the surprise entirely. This scenario repeats constantly across the country, precisely because assistance terminology like forgivable, deferred, and silent second sound similar but carry very different legal consequences. Start by identifying the exact type of assistance offered: grant, forgivable loan, deferred loan, or tax credit. Each has a distinct repayment structure. Request the full amortization or forgiveness schedule in writing before signing any offer, not just a verbal summary from your loan officer. Confirm the required occupancy period and what specifically counts as a violation, such as renting a room or relocating for work. Verify your household income against the program's published limits for your specific county, since these figures are updated annually. Ask directly whether a federal recapture tax could apply to your loan type, and under what income growth or sale timeline it would be triggered. Check whether the assistance stacks with other programs, since some federal and state combinations are restricted or prohibited entirely. Confirm the purchase price cap for the property against the program's current limit, especially in rapidly appreciating markets. Review whether the assistance requires a homebuyer education course, a common but often overlooked prerequisite for final approval. Ask your lender to disclose all fees associated with administering the assistance, since some programs charge processing costs separate from standard closing costs. Finally, keep a personal copy of every disclosure signed, stored separately from the closing package so you can reference the exact terms years later. Remember that these rules shift meaningfully from state to state and even county to county, so a program popular in one region may not exist or may work completely differently elsewhere. Government assistance genuinely helps qualified buyers close the affordability gap, but only when the buyer understands the legal mechanics behind the money, not just the headline benefit. The single most valuable habit any buyer can build is treating every assistance program like a contract, because legally, that is exactly what it is. If this breakdown helped clarify how government home buying assistance really works, subscribe to Land Guide USA for more state-specific guides on land and home purchasing rules across America. Tell us in the comments which state's assistance program you want us to break down next, and we'll build the next investigation around it. This has been Land Guide USA.